All right, so you start dabbing your toes in the water, right? Looking at investing, how you want to do it, which route are you going to take? Maybe you've been investing for a while and you haven't really looked at your portfolio and you decided you need to take a look at it, rebalance it, something like that. And you start seeing these ETFs pop up everywhere. You don't really know what's going on with them. I mean, what are they? How do they work? What's the purpose? So many questions. Well, ETFs, sure, they might sound intimidating, right? But they're not. At their core, they're just diversified portfolios like mutual funds, and they just get traded like stocks. Pretty simple, right? But how do they work exactly? I mean, are they a good addition to, your taxable or your tax deferred or tax free accounts, like whichever one you have? Well, that's some good questions. How about we dive into that and see if maybe ETFs are a good addition for you or maybe they're not. Let's figure that out. So let's start off with the basics. All right. So, like mutual funds, ETFs enable investors to purchase an interest in a diversified portfolio of securities. Now, this is going to include stocks, bonds, just any number of assets, right? It's just, there's so many. But unlike a mutual fund that is not exchange traded and only trades once at the end of the day, ETFs are more conventional, right? In which they're like stocks because investors get to buy and sell shares at the fluctuating market prices on the exchanges throughout the trading day. Now, many ETFs track the performance of a market index, right? There's a bunch of different indexes, so there's a bunch of ETFs that track the indexes. For example, an ETF that tracks the S&P 500 index, right? That would invest in most or all of the large cap US equities. Now, there are ETFs that track all kinds of indexes. I mean, just a bunch of them. So it's likely that you're going to find one that gives you exposure to the assets that fit your objectives, your outlook on life, the things that you like, right? There are corporate bond ETFs, for example, right? As well as those that track indexes of emerging markets, the technology sector, mid-sized companies. I mean, the list goes on and on and on. And since ETFs invest in most or all of securities in an index, the ETF returns typically mirror the returns of the index it's tracking instead of outperforming it. Now, there is a growing number of ETFs that attempt to achieve a better rate of return than particular indexes. Now, these are going to be called actively managed ETFs, right? Because they're run by an advisor who buys and sells securities to accomplish a specific investment objective. So, how do you actually earn a return from an ETF? Well, the underlying security, it's going to pay interest or dividends, right? And then you sell your ETF shares for more than what you paid for them, right? Buy low, sell high. And then the ETF distributes, capital gains. So those are three of the main ways. Okay. Well, what about the benefits of purchasing ETFs, right? Well, one of the first things we want to talk about is that diversification. Like mutual funds, ETFs offer an easy way to access a basket of diverse securities, right? Just a whole bunch in one spot. Now, spreading your investments among different kinds of assets can help you mitigate some of the risk of investing. While you could technically purchase many individual stocks or bonds to achieve diversification, do you really want to sit there and research each company, the stock, the history, and try to make a prediction? I mean, that sounds like a pain, right? And not to mention, you might need to buy a service to even get some of this information. So now it's expensive. You don't want to do all that stuff. It's not worth it. Well, another potential benefit is going to be some tax efficiency because, generally speaking, ETFs have the ability to meet redemptions in kind rather than by selling the portfolio securities. So, this arrangement minimizes capital gains distributions As a result, the SEC notes taxes on ETF investments have been historically lower than those for mutual fund investments. Pay less taxes. We like that. Then we got the low barrier to entry. You can buy and sell shares in ETFs through a brokerage account, just like how you'd buy stocks. And there's so many brokerages now that they offer commission-free trades. In addition, plenty of ETFs, they're not even that expensive. Another bonus, ETFs that passively track an index generally have really low expense ratios because they're less costly to operate. Again, if that's going to translate into lower fees for you, that means more money to invest. That means you're going to get a better return. Win. Just a win. Another potential benefit is going to be the transparency of it. You can see the market price of an ETF throughout the day, right? I don't recommend checking it every day throughout the day, right? And some ETFs will even publicly disclose their holdings daily. Again, I don't recommend checking this every day, right? Now, that disclosure can be useful, right? If you want to monitor exactly what you're investing in, especially if you're trying to avoid certain sectors or companies that don't align with your values. Okay, well, if there's benefits, there's downsides, right? So what are the potential downsides of investing in ETFs, right? All right. Well, of course, as with stocks, bonds, other securities, ETFs, they lose value, right? They can go down in value, and you could just lose your investment outright. Well, there's a couple other things to consider too, right? It's not just that. Like we talked about earlier, fees. Fees. They're back. Because if you buy or sell shares through a brokerage that doesn't offer free trading commissions, those fees are going to add up. And that's going to make a real dent in your investment returns. Further, reinvesting a dividend payment or capital gains distribution can be complicated. Again, incurring more brokerage fees, meaning you're going to make even less. Okay, well, what about the potential for premiums or discounts? Because an ETF can be priced above or below its net asset value, right? That's the value of its underlying holdings in the marketplace. And that's because other factors can affect the market price, including investors' demand for the fund. However, the ETF market is structured to minimize the risk of these premiums or discounts to net asset value developing, right? So there's a lot of things that you guys need to consider if you want to get into ETFs. Now, again, very low barrier to entry, not very costly, a lot of times very low fees. So they're very similar to mutual funds, right? And there's a lot of debate, ETF or mutual fund, but if you're doing the research, you're looking into it, you know what's right for you, And again, make sure you're doing the research and you pick something that's right for you, because what's right for you is not right for the next person, okay? So I hope you guys enjoyed this video. If you did, smash that like button, but until I see you guys in the next video, y'all be safe.